It's time for the Phil Ferguson Show.
This is Phil Ferguson, and you are listening to The Phil Ferguson Show, the cleverly titled Phil Ferguson Show, by the way. It is February of 2022. Wow, we made it. We made it all the way to 2022. It seems like only like 5 or 6 years ago was Y2K. I know, it's actually 22 years ago, but wow, time goes by. And of course, I happen to notice that I've been doing this, not the podcast, but investing and helping people with my company, Atheist Financial Planning, for give or take now around 25 years. Wow. I don't know. It just 25 years doesn't seem like that big of a thing now, but of course 25 years ago that would have been how long I'd lived, give or take. So actually pretty amazing. And let's see what else we got going on. Speaking of Polaris Financial Planning and or TD Ameritrade, the qualified custodian that I normally use, they are doing a thing where if you have an account with $0 in it and nothing has happened in that account in the last 24 months, they're going to close it. That's fine. It's fine. If you weren't putting money in or you weren't taking money out and you had $0 in there the entire 2 years, and I've already had several clients email me because these letters have started going out, and I meant to mention that in the last episode, but I got distracted. So it's okay. If you get a notice, you can call me, you can email me, we can talk about it. But the gist is, if you're a client, or even if you're not a client and you have accounts at TD Ameritrade, this is something they did a few years ago, and they're doing it again. And they're just looking at accounts that are dormant, and they're going to send you an email or a letter that says, hey, by the way, account ending in 1234 or whatever the last 4 digits are, we're getting ready to close her up. And if that's cool with you, which it probably is, you can let it close. If you don't want the account closed, you can let me know, or you could contact TD Ameritrade directly. I'm sure there's contact information on the letter that you're going to get. So we've got that going on. Fun Fed stuff before we get into the show. And I almost forgot to mention, we're going to have a loss of faith interview coming up later in the show. There's a nice segment on what's called longevity insurance, where you get money if you have the misfortune of living too long. And we'll go over all the details there. And I also did another segment, kind of almost a bonus segment. I had a couple people ask me about the details, the specific technicalities of how you take money out of your Polaris plan, out of your portfolio in retirement. How does that actually work? When do you use the cushion? And if you use the cushion, well, when do you refill the cushion? How the fuck does that work? And so I go over, again, a very overly simplified example of how to do that. So, hang tight. You'll get to that. Anyway, back to the Fed. The Fed, the Federal Reserve, is probably going to raise interest rates. Now, when I say they're going to raise interest rates, the only rate that they can really set in any kind of precision, and even there's kind of some slop, is what's called the Fed funds rate. This is the overnight lending rate. And that's the overnight lending rate that banks have to pay to borrow money back and forth from each other to meet the minimum reserve requirements that a bank must comply with every single day, every single night. The bank has to have enough money somewhere, a certain percentage of all of the deposits. They have to hold some of that money, and that's meant to provide a little bit of extra security and cushion in case there's a problem with that bank. So this is one of the many regulations where I guess the government kind of, in a way, helps you out because they want to make sure that the banks are secure. And if a bank collapses, they can step in and do that Whereas if you're in Bitcoin and it goes to zero, there's no backstop, my friends. It just poof, disappears. So do what you want with your money. But anyway, the Federal Reserve, the current rate is, I think, around 1/4%. And a year ago, the Fed was saying they weren't going to do anything until 2023. And then they said, well, maybe really early in 2023. And then maybe really late in 2022. Okay, maybe during the summer of 2022. Maybe there'll be two upticks. Maybe there'll be 3. Well, the consensus of economists and financial experts that have been, quizzed by media companies suggests that the Fed, when they meet next, I think it's March. I don't have the date on the top of my head. When they meet, the odds, the gamblers are placing it that it's not only going to go up 1/4, but it might actually is expected. The vast majority of experts in this field are leaning towards 0.5%, with actually a few more people suggesting 0.75 and a few less people suggesting 0.25. So there's going to be about 0.5% increase in the overnight Fed funds rate, which means the banks pay more to borrow money from each other. Now, in essence, if the interest rate goes from 1/4 to 0.75, the bank is pretty much going to do what they were already doing. But it's a little bit more expensive to borrow the money. And we're talking sometimes millions and tens of millions of dollars. And that might create a situation where some banks on the periphery might want to lend out a little less money. And so with a little bit less money flowing, that is a brake on the economy. I think it was the Fed Fund chair. Oh my God, I can't remember the guy's name, so I'm going to skip it. But he said the Fed's obligation is that when the party starts to get out of control, they are there to take away the punch bowl, filled with alcohol, of course, the punch bowl, and make sure the party doesn't get out of hand. And for some people, it's feeling like it's getting out of hand. For some people, it feels like it got out of hand 10 years ago and it never got fucking back in their hand. Okay, sorry. I am sympathetic, very sympathetic to people that can't pay their bills and how prices and inflation hurts them. If if you get a 5% pay raise in your job and then inflation is 7%, that's kind of a buzzkill. You think you got one of the biggest pay raises you've had in years, and then your gas bill went up. Just ironically, our cost per therm, I think it is, more than doubled for my gas company. So it was a bit of a shock. Now, thankfully, I had historically pretty low heating energy gas bills in the winter, even with a big house. But it more than doubled this year. So November, December, it's going to be this way for January. And of course, probably in February as well. So that's kind of a painful thing. And if you're working hour to hour, an hourly pay, and it went up 5%, and your gas bill doubles, that's going to be rough. Anyway, I get diverted here. The Fed is now guessed, people are gambling, betting, calculating, it's going to be a 0.5% increase, with maybe another 0.25% or 0.25% or another 0.5% increase before the end of calendar year 2022. Wow. Abso-freaking-lutely wow. And of course, we've talked about this in relationship to bonds. What that will tend to do is make bonds a better place to be, because the interest rates will be higher. But that means if you already own a bond that has a low interest rate, it's less valuable. This is the dream scenario, or the nightmare scenario, of what I was warning against. You might still have time to hedge your bets a little bit. But last I looked, as an example, the Vanguard long-term U.S. government bond fund in 2021 lost 5 or 6%. And in the first 5 or 6 weeks of this year, it lost another 5 or 6%. So you're down, give or take, 11% in bonds. And it could get a lot worse. A lot worse. Now, one of the problems with raising the overnight and the short-term rates too quickly, it produces what's called an inverted yield curve. Normally, overnight lending or borrowing is very cheap, and then 3-month, 6-month, 1 year lending pays a little bit more, And if you borrow money for 5 years, and this can be in any format, but usually bonds, 5-year bonds pay a little bit higher rate, 10-year bonds pay a higher rate, and 20 or 30-year bonds pay even a slightly higher rate. Because if the rates were equal, why would you get a 20-year bond at all? You would just get a 1-year or a 5-year bond, and then when your 5 years are up, you sell it and you buy another 5-year bond. So if you're locking up your money for more time, the way it goes generally is that you're going to get a slightly higher interest rate. If short-term rates change very quickly, you can get the situation, let's say as an example, the short-term interest rate had been for bonds under 0.5%. If it goes to 1.5% and 2%, and a 10-year bond goes from 1.6 to 1.9, which is about where it is now, you could get more dividend yield on a short-term bond than a 10-year bond. That's bizarre. And there is a correlation, not a causation in my opinion, but there is a correlation that when short-term interest rates are higher than long-term interest rates, that is a sign of a recession. Now, sometimes you get a recession afterwards, sometimes you don't. So what does it mean? It's a sign. So it's correlated with something, and I don't know that it causes it. But one of the ideas the Fed has come up with, and I'm waiting to learn more about what they're going to do, is they are going to dramatically curtail quantitative easing. What the fuck is quantitative easing, I hear you asking? And I'm glad that you did. The Federal Reserve can enter into the bond market, and as the U.S. government issues new bonds, they can buy them. They aren't usually messing around in the short-term range, but 10 years plus. And they go buy them. And so every so often, the U.S. government puts up a lot of bonds for bidding, and there's, a handful or dozens or a couple hundred people and companies that can go in there and bid on the bonds and either own them themselves or sell them to investors that use their brokerage firm or their company. Well, when the Fed goes in there and bids on the bonds, the prices go up, and that pushes down the actual yield that you get. And so this is a function where the Fed basically, and the people who are, more libertarian or hate the Federal Reserve or think that the U.S. government shouldn't be involved with adjusting interest rates, this whole process pushes down long-term interest rates so that it's cheaper for you to borrow money for a car, for your house, maybe your credit card bill. And it makes it easier for you to get money, and it makes it cheaper for you to get money. So you're more likely to get a loan. You're more likely to qualify for a loan because paying it back is a lot easier. And so that's called quantitative easing. There's other things that I'm not going to get into, but the Federal Reserve can go in and buy bonds that are being issued by the government. Well, they have indicated that they're going to slow that down. They're not going to buy as many bonds. But now they're kind of hinting that they're going to slow it down a lot. And they might even sell some of the bonds that they've bought, because at some point they either have to sell them or they hold them to redemption. Well, if they start selling them back into the marketplace, that means that there's a lot more bonds available. So the supply is high. If the supply is high, then the prices go down, and of course the yields go up. And so if you're holding something, it becomes less value because the price went down. But when new bonds are issued, they might be at a higher interest rate, which is one of the things I'm waiting for. It might be a rough year or 2 or 3 in bonds where, quite frankly, you're probably going to make close to nothing unless you're taking some risks. And if that's what you want to do, that's cool. But in this case, if the Fed shrinks the amount of quantitative easing that they're doing and or sells the bonds that they have into the marketplace, that'll drive down the prices of bonds. It'll drive up yields. So a year or 2 or 3 from now, you might be able to get long-term bonds that aren't paying 1.5% to 2%, but closer to 3, 3.5%, 4%. Now those bonds look a lot more sexy. Because if interest rates go down and you're making 4%, your bonds could actually become more valuable than just paying the 4%. Anyway, I digress. So one of the reasons the Fed is thinking about doing this is that you won't have a yield curve inversion, which in and of itself is not a problem, but maybe psychologically it is for some people because they go, oh my God, this is a sign of a coming recession. And if everyone thinks it's a sign of a coming recession, well, then maybe it is, because everyone acts as if it's a recession. And then it becomes a self-fulfilling prophecy. So if the Fed goes and changes quantitative easing at the same time, short-term interest rates will drift up, and intermediate and long-term interest rates will also drift up. So the curve is no longer at risk of being inverted. So short-term rates might go to 1.5%, 2%, and long-term might go from 1.9 to 3 to 4%. And so the yield curve stays in the way that you would normally expect it to be, where the longer you lend somebody money, the more you get. Anyway, hopefully that's helpful in some small way. We'll take a quick break and we'll get into some of the really good stuff of the show.
Section 5. Was Jehovah a God of love? Did these words come from the heart of love? When the Lord thy God shall drive them before thee, thou shalt smite them and utterly destroy them. Thou shalt make no covenant with them, or show mercy unto them. I will heap mischief upon them. I will send mine arrows upon them. They shall be burned with hunger, and devoured with burning heat, and with bitter destruction. I will send the tooth of beasts upon them, with the poison of serpents of the dust. The sword without and terror within shall destroy both the young man and the virgin, the suckling also with the man of grey hairs. Let his children be fatherless, and his wife a widow. Let his children be continually vagabonds and beg. Let them seek their bread also out of their desolate places. Let the extortioner catch all that he hath, and let the stranger spoil his labor. Let there be none to extend mercy unto him, neither let there be any to favor his fatherless children. And thou shalt eat the fruit of thine own body, the flesh of thy sons and daughters. And the heaven that is over thee shall be brass, and the earth that is under thee shall be iron. Cursed shalt thou be in the city, and cursed shalt thou be in the field. I will make my arrows drunk with blood. I will laugh at their calamity. Did these curses, these threats, come from the heart of love, or from the mouth of savagery? Was Jehovah God or devil? Why should we place Jehovah above all the gods? Has man in his ignorance and fear ever imagined a greater monster? Have the barbarians of any land in any time worshipped a more heartless god? Brahma was 1,000 times nobler, and so was Osiris and Zeus and Jupiter. So was the supreme god of the Aztecs, to whom they offered only the perfume of flowers. The worst god of the Hindus, with his necklace of skulls and his bracelets of living snakes, was kind and merciful compared with Jehovah. Compared with Marcus Aurelius, how small Jehovah seems. Compared with Abraham Lincoln, how cruel, how contemptible is this God.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. This Investing Skeptically segment is about longevity insurance. My wife actually sent me a link to Kiplinger's magazine, and it had this little article, and I thought I would share it with you, and I hope you find it as amusing as I do. First of all, this article is written, and I'm not going to even promote his name, but his company is quoted as a leading online provider of fixed rate, fixed indexed, and immediate income annuities. You can contact them for a free quote, which is great, no problem. But this is not some researcher or financial expert at Kiplinger's writing about I guess an investment, a way to waste your money. No, an annuity, how to buy an annuity. It's not written by an independent person. It's written by someone who's selling the very thing that they're telling you is fantastic. So basically, it's paid content. I can't imagine that Kiplinger's, well, maybe they do. I don't know what's worse, if Kiplinger's allows you to print this without paying, or if it's worse that they take money from the person who writes it. I don't know. I don't know what's worse, and I don't know if either one of those are the case, but written by someone who has a vested interest, let's say. So the gist of this is that what if you live too long? So it's kind of the opposite of life insurance, where you get life insurance, maybe you get life insurance, if you're worried that you're going to die too soon. And I think almost always is too soon. Of course, there's exceptions to everything, but assuming short is too soon and you want to protect your family, you might have some term life insurance, particularly if you have children at home and it might be hard for your spouse to get a full-time job taking care of the kids. You got bills to pay. Life insurance, term life insurance, in that kind of setting does seem to make a lot of sense to me, and you can shop it, and it's very cheap because your odds of dying are very low. So there's that. But this is something different, and the idea, the pitch, the sales pitch is that, oh my goodness, your portfolio may not be big enough for you to take out what you need every year, and if you take out what you need every year, you at some point may go broke and absolutely run out of money, and you don't want to have that happen. So again, it's kind of preying on limited, inaccurate understanding of how investments can work. And that's a lot of people, because who teaches you how investments work? I mean, outside of this show, almost everyone in the biz is better off you not knowing how things work. So there's not really much incentive for them to teach you things. So anyway, you put money into this, what did I call it here? Longevity insurance. It's just a different annuity. I love how they can call it insurance. And you put money in, and the example they gave was $150,000. So you've protected $150,000 from yourself, so you don't spend it. And then you can spend all of the rest of your portfolio. And even if you do spend everything else in your portfolio, this is sitting aside, growing, and it's going to be there for you even if you spend all of your other retirement money. And before I get in some sample math, one of the things that you need to know is that if you get one of these and it might start paying you money at the age of 80, if you do not make it to the starting age, in this case, 80. If you die at 79, you get zero. Your family gets zero. Your estate gets zero. Any charity you might have wanted this money to go to gets zero. The annuity vendor, the insurance company, pockets all of your money, all of it, and they just get to keep it. It's pretty cool. If you're selling these things, this is great. And the phrase that he had in the article here says, buyers who do not live to an advanced age, in effect, subsidize those who do. So this is a very clever way of telling you you could end up with nothing, but it's okay. You're helping your fellow mankind. No, you're not. It's going to the insurance company. They've done the math on this. But just in case you're worried about that little problem, what you can do for a small extra annual fee or cost, you can get what is called return of premium guarantee. So let's say you're 65 and you want to put $150,000, and I'm using this as a starting point because they had some math in the article from Kiplinger's, and so I want to be able to tell you what they said, and then I'll tell you what I'm going to say. So at this example, at the age of 65, you can put in $150,000. If you die before any of the money comes out, you can get a return of premium guarantee. Like I said, there's an extra fee for that. I don't know what that fee is. I have not included that fee in my calculation, so the numbers would be lower. And of course, every little thing that you add on to insurance products and annuities, which sound great, often it's just an additional way for the person selling it to you to make even more money
but it gets so complicated, it's hard to understand. So I made a theoretical calculation, again, assuming you start with $150,000 lump sum at the age of 65. And you want to set that aside because the financial advisor, I know, really the salesperson, has suggested that you do this because this way, if you spend the bulk of your money, this little part, let's say you have $1 million and somehow between 65 and 80, you spend all of that, which I guess can happen, but that's poor financial management on your part. But let's say you do, and this $150,000 is set aside, and I'm going to assume it grows at 5%. The actual growth is probably less than that. I don't have an actual annuity life insurance contract in front of me. Often they will make declared rate or committed rate, minimum guaranteed rate. It all gets complicated. And often with annuities and life insurance products like this, the effective return I see most people getting is around 3 or 4%. They have to give you something, otherwise you would notice that it's not going up. And you would tell your friends that you got fucked. So they want to make it enough money that you don't notice that it's bad, but often they make more money from your money than you do. So I'm going to use a very conservative rate of return of 5%. If you make 5% every year and you take no money out, you could do this on your own. You could set up your own fucking account, right? You don't need an insurance product to do this. You can create a whole new account for yourself and put this $150,000 in it, invest it painfully conservative, in my opinion, and make 5%. You could have probably 2/3 bonds and 1/3 stocks and make 5%, and you just sit it there and you don't do anything with it. At the age of 80, you would have about $330,000. $330,000 because 15 years is a long time. 15 years at 5%, the value does go up. You now have $330,000 in your name. If you die that day, your portfolio, your estate has $330,000. And depending on who you assigned as the beneficiaries or whoever your trust says gets the money, they get $330,000. If you pay extra for the return of premium guarantee, I'm going to say you're not going to make 5%. Let's say you make 4%. And in a funny way, it doesn't matter what you do or do not make on paper because you died. And the only thing that the beneficiaries receive is the premium back. So they get the $150,000 back, which does sound pretty cool, but you could have had $300,000 to give to your beneficiaries, $330,000 if you died right before it started. So what's better to give to your beneficiaries, $150,000 or $330,000? And of course, the insurance company is investing this money. I don't know how they're investing it. Are they making a conservative return of 5 and giving you 3? Are they half in stocks, half in bonds, making 7 to 8%? Are they really heavily into stocks because it's a long-term play for them and they're taking a little bit of the risk and they make 6, 7, 8% per year while promising you something like 4, and maybe you only end up getting something like 3. So this promise that you'll get your money back, your initial $150,000, that means that $150,000 that you get back did nothing. You could have put it under your mattress and had $150,000. Anything and everything that they've made all along the way, the extra $150,000, they get to pocket all of that when they give you the return of premium guarantee. They give you your starting money back that you lent to them at 0% interest for 15 years. Of course, it might be worse than that because depending on the language in the contract, there may or may not be additional fees, holdbacks, reserves, and of course, every year you're paying expenses via an expense ratio and other things that may be 1 or 2 or 3%. And there may be a line in there that says, well, you have to pay that. So you get the 150 minus expenses that you agreed to by signing the contract, even if you didn't understand it. But I'm assuming they're going to give you 150 back. So in this case, you don't make it to 80. You don't get to start taking money out, and you get your $150,000 back. And like I said, even a conservative portfolio making 5%, it'd be 330. So again, even with the guarantee of your money back, I don't think it's a good deal. Then I started to look at what happens. You make it to 80, awesome, and you start getting monthly payments, and then you die. Well, if you didn't pay for an additional feature, the money disappears. Well, it doesn't really disappear. It just goes to the insurance company. The theoretical $330,000, they just pocket that. They get to make that. So, of course, the salesperson says, you don't want to do that. Especially if you bring it up. What happens if, and you go, oh, there's an additional rider for an additional 0.5% or something every year that you have to pay. What they'll do is they'll promise that if you start taking out the money, even if you die a month later, they'll pay your spouse or your kids or your estate, whatever the rules are, they'll pay the promised amount for a minimum of 5 years. Which, okay, in this article, the author suggests that, I must find it here, that in this situation that I'm describing, at the age of 80, you might get $2,100 a month. So we're going to call that $24,000 a year. If they promise to pay out for 5-year minimum, that is going to be about $120,000 that they could pay out to the estate, which is pretty cool. But again, if you just invested the money, you'd have $330,000. And of course, to get the 5-year minimum payment guarantee to your estate or your spouse, it requires an additional rider, an additional fee that you pay. So you're not going to get to $330,000. You're paying more money to the insurance company. You could have something that pays on your life only, and then for 5 years on your spouse. Or you could have one that pays for you, and if your spouse is still alive, it'll pay for them for the rest of their lives. Of course, all of this creates more fees, more income for the insurance company, and they get to pocket even more money. The interesting thing is the average U.S. life expectancy. We're going to talk about some brutal facts here in reality. In the United States, if you're listening here, the average life expectancy is 78.5 years. And of course, the insurance company knows this. What that means is that a good half, give or take, and we could argue about how the mathematics of all of this works, but a good half of the people that buy a policy like this will never get a dime out unless they pay for some of these extra fees. And then, of course, your returns are smaller. You're not going to get a dime because life expectancy is 78.5. If it starts at 80 or 85, the older you want it to start, the less likely you're ever going to collect a dime out of this. It's a magical thing for a company to sell so that you can buy one of these things and hand over your money. Now, if you don't get one of these things and you set $150,000 aside and you make only 5%, like I said, you will have about $330,000 at the age of 80. You on your own could take out money. In this case, I used 7%. You're going to take out 7%. It's not the 4% rule. It's not the 5% rule. Today, it's the 7% rule. I'm using this to be a little bit extreme. I'm going to stress test the idea of what you can get with the $330,000. So with $330,000 at 7%, you can take out almost $23,000 a year. True, it's not the $24,000 that you might have been promised, but again, you're not going to get the $24,000 because you had additional things to draw it out and stretch it out and make it go longer. So the payments are probably going to be lower than that, or the expenses are going to be higher than what you thought they were. Now, of course, if you take 7% out of a portfolio, if that portfolio makes nothing, you get to 330 and you say, I'm done, I'm just going to put it in cash. You take out 7%, you can do that for around 16 years. And of course, you're 80, right? So this is one of the tricks with the 4 and 5% rule. It depends on you. It depends on your availability to delay or defer payments. It depends on your age and how long you're going to live. Because as an example, if you start taking money out of $1 million portfolio at the age of 65, if you follow the 5% rule and take out 50,000, that portfolio is invested in cash or not invested at all. It just makes nothing. You can take out 5% for 20 years before you burn through the portfolio. In this case, we're going to 80, and we're going to take out 7%, and I'm going to assume the portfolio still keeps growing at 5%. It's mostly bonds. What will happen is at the age of 100, you'll have only $73,000 left if the portfolio makes 5 and you pull out 7. So you're eating into the portfolio. But you still have money left when you're 100. You could probably do this for 3 or 4 more years. Odds are you, dear listener, are not going to make it to the age of 100. I also kind of jokingly, to put a little humor on the morbidity of all of this, if you do make it to 100, you're probably not going to be aware of it. But this is a case where if you die right away, you could leave the 330 to your spouse or children. If you keep living, you can take out 7%. If your portfolio only makes 5, you can do that for your life expectancy and probably many years beyond, and still have money left over for someone else to have. So I'm just not feeling what am I getting from the insurance other than expenses and payments and premiums. You can have the 330,000 and you can take money out of it. It's kind of like having your cake and eating it too. So you have the $300,000 plus and you get the monthly payment. So I think that's fantastic. I don't think this is a good idea for anyone to invest in. If someone has one of these or sees an actual contract, please feel free to send it to me. Maybe I can go over this in more detail. But every way I look at this, it's better if you really, really don't trust yourself to put it into another account and let it sit and grow and know that that's there for you when you turn 80 or it's for your kids or whatever. So that is a new thing for Phil. I've only done this 23 years, 22 years. Who cares? But longevity insurance or longevity annuity. I hope you enjoy.
You're listening to The Bill Ferguson Show.
All right, everybody. It's one of those little sessions where I'm going to talk to somebody who has left religion and their experiences, and it's someone I've met in person. It's been a while, I'm sorry to hear, but we've met in person a couple times over the years. And for security purposes, we're going to just call this person JC, like Jesus Christ. What do you think, JC? That work for you?
It sounds perfect.
Excellent. And like I said, we have met before, and we've talked a little bit about it, but not much lately. You started, I guess, grew up, indoctrinated, believed in. Tell us about your religious history.
Sure. So when I was born, my grandfather was the pastor of our church, and my dad was the youth pastor. And so I was in church 3 to 4 times a week.
Oh, yeah.
From birth until about 13 or 14, where I just told them I didn't want to go, and they just didn't want to fight me about it anymore.
Well, so you just stopped going, but did you stop believing it? Did it not make sense, or you just didn't want to be bothered with the people?
Yeah, so it's a great question, and I think, and that's been a little while ago. So, human memory is fallible, but to the best of my memory, there was a lot of things that were going on at the time where, I wanted my independence. Their version of Christianity was pretty rigid. My parents they were getting divorced at that time, or shortly before that. So there's just some teenage angst that went on, and there was some natural rebellion that happened. So I just decided, I wasn't allowed to listen to anything but Christian music or watch anything but Christian movies up until that point, which was a horrible existence.
My God.
I missed like a decade and a half of pop culture. But I finally just started doing it, and they just kind of stopped fighting me about it.
It's funny because it reminded me that as far as popular music, my mom listened to talk radio, news radio out of Chicago, WBBM. And my dad, if he ever listened to any music, it was like marches, and maybe some really deep old country from like the 40s, because he was relatively old when he had children. And so that was my exposure to music. And I don't recall even having a radio or listening to much until like halfway through high school. And then all of a sudden there was this whole alternate world of music that I knew nothing about. So there are these times where my wife and I are talking about something that was a hit in the 70s or 80s, but wasn't something that I could play at a wedding as a DJ, because I did that. And she's like, "You've never heard this song?" I'm like, "Never heard this song." She's like, "This was a huge hit." I'm like, "I got nothing." So I can relate to, a decade and a half of not really knowing anything about popular music, and it wasn't anything that was forced on me. I know all about Love Boat and Fantasy Island because we watched the shit out of that show. But to be only listening to Christian music, that's rough, dude. So is there anybody that you liked? What is it, Pantera, or I don't even know who the names are anymore. Amy, what was her name? I can't remember. Who did you like? Did you like nobody? What did you think of the music?
When I was growing up, Petra was the shit.
Yeah.
That was the old Christian rock band. And like, I didn't know any better, right? They controlled my frame of reference. So that's what I thought was great music. And then once I just started exploring on my own, I'm like, holy shit. Like, there's this gigantic other world out there. I still have people that will refer to things that happened back in my youth, pop culture wise. And I have that same reaction that you did. I have no idea what you're talking about. So then I got to go home. Thank God there's YouTube. Now I just look it up and I can, after the fact, decades later, experience what I should have felt back when I was a kid.
So you come to your computer and you go, "What is the Fresh Prince of Bel-Air?"
Yeah,
it's weird because part of me also misses, and I'm concerned, with exceptions like yours aside in my music thing, a lot of people, the major part of the population had a shared experience with the programs that everybody watched, because there's 5 channels. But now you could be in your 20s, and if you've listened only to Fox News and certain channels and networks, you could have a very, I think, distorted view of reality.
Correct.
Wow.
Yeah, yes, you're exactly right. That's something I'm worried about for my kids.
Yeah.
Which we can get into later if you want to. But it's certainly possible. I lived I don't want to make it out for more than what it was. I lived a more open existence compared to some other people that I knew in the church. But
right.
Yeah, it was still restricted.
Yeah, it's clearly, you haven't indicated anything horrific like some of the stories we've heard, but you were allowed to stop going to church about 13, you said, I think.
Yes, sir. And
you just didn't want to go to church, or had you already decided that this is all bullshit, or you just were kind of indifferent?
I was pretty angry at that point. I don't know if I accepted that it was bullshit. I think I still remember feeling like it was true and that I was maybe not on the right path, but it's something I didn't have to deal with at that point, because I was pretty young.
Yeah.
You always feel like you're immortal at that age. I could just set it aside, put it in a little box, and kind of, deal with it when I wanted to. And that's probably how I lived until, early adulthood. And then one day, I've always been interested in philosophy, and I was on YouTube, and I started just searching around, and I stumbled on, Sam Harris and Dawkins and the Four Horsemen. And that's when I really kind of took a hard look at it again. And that's when I felt like I became an atheist for intellectual reasons, not because I was angry or because I wanted to rebel against my parents, but just because it doesn't make any fucking sense. And it was flabbergasting to me. Like, when I really sat down and thought about it, that I'm like, this is still a thing. This far in humanity's development, this is still what we believe, what a large majority of people believe. And so then it just started to fascinate me, and I just started to read everything that I could about it. And I still have that same feeling that I'm like, how is this still possible? Like, how does this still have this much hold as it is right now? I know it's fading away. Like, I know that, to me, we're on the side of good and truth, and our cause is just. There's not sufficient reason to believe that any gods that have been proposed so far exist, in my opinion. but yet it still has a lot of influence, especially around the circles that I keep.
Yeah, it does. Now, when did you say you were pretty sure you're atheist after watching these YouTubes? Well, what kind of age were we talking about there?
Yeah, I'd say mid to late 20s.
Okay.
It's kind of when I really started getting interested in it. Maybe early 30s. It's kind of hard to put my finger on it.
Yeah.
But in between, I married a theist.
Yeah.
And at that point when I married her, it just wasn't a big deal. She had her beliefs. I've always been surrounded by theists, all of my grandparents and my parents and almost every person in my immediate family is a theist. So it's not a big deal for me to live in peace with them and to treat them with respect. So I married her. I knew she was a theist, and she asked me what I believed. I don't even remember asking me it. She says that I said at that point that I believed in some type of higher power. And of course, that could be conscious or unconscious. It's a pretty vague answer.
Yeah.
I don't remember exactly what I said. But man, going back and looking at it now, my feelings changed pretty drastically from that point on, after we had already been married and had children and everything.
Yeah, it can be a challenge. And you and I were talking pre-show that my wife used to be a believer, and now she's not. She still doesn't like the A word, the atheist word, just from a life experience of that had its baggage. But it can be really hard for people to, like in your case, I don't know your wife, and that's fine. I'm sure she's a delightful and wonderful human being, but it's so easy for us to hear what we want to hear when if you're hinting at a higher power and you're trying to be delicate, the listener can interpret that as, oh, they're Christian just like me.
Yes.
Because everyone is, and you didn't go out of your way to say that you're not, so you must be, and that gets put in a box, and then life comes around, and suddenly 10 years later you ask the question again and you give a slightly different nuanced answer, which rings as opposite to the listener or to the questioner from what they asked maybe 10 years ago. It can be a bit of a challenge, but sounds like you're pulling it together, and that's great. I know I just had a friend of mine say, Phil, you know what your problem is that you don't give Christianity respect that it deserves. And I was like, I can't even believe you said that shit to me. I'll grant you that I don't give it respect, but I won't grant you that it deserves any of it, because it's bullshit. And like you, I look at it and I go, how is so many people in the world and so many people in a reasonably well-educated population like the United States, and I have reasonably well-educated in parentheses, how? I don't know. Sometimes it just surprises me. Sometimes it just makes me feel like I want to curl up and crawl under the blankets and hide for a decade, hoping it'll go away.
Yeah, agreed. I have that sensation a lot. It's shocking to me. And the thing was, as I kind of started questioning things and going down that journey, I was hopeful that I could convince other people or help push them down, because I'm like, to me, I've always thought that reason is the great equalizer, right? I can persuade someone. We're both searching for truth. If something seems obvious and blatant to me, then it's got to seem that way to them. But that is the tricky thing about indoctrination. It's not always that way.
Yeah, it's the logical argument is often not very effective if someone doesn't want to hear it. It's just a struggle. So at this point in time, I think you would be fair to say you are an atheist, but there's plenty of people 100%. Around you. Pardon?
Oh, 100%.
Okay. But there are people around you that, we're not using your actual name. We're calling you JC, but there are people around you who kind of maybe know something's going on, but they probably don't really understand the depth of your lack of belief. Would that be fair to say?
Yeah, that's fair. Everybody in my social circle, because of my family, is pretty solidly theist, and for the most part, I know that if I advertised the fact, I think it'd be hurtful to my grandparents, who are both in their 80s, and also to my parents. So I struggle with that a lot, because, as I said, I believe our cause is just. I think that anybody that tries really hard to look at it objectively. And even if they've been told things are true by the people they trusted when they grew up, if they set those aside and if they just consider it and say, hey, could those people have been mistaken? Could they have been victims from the people that came before them and told them that this was true? And could they have just trusted people that have given them the right answers through the vast majority of their whole life? Like if they took that moment to consider it, I feel that almost anybody would come to that conclusion that, yes, there's not enough evidence to believe that this is true, and there's too much conflicting evidence to accept it. But trying to get that message across to other people, it is a delicate process. And at some point in people's lives, it's not worth the effort because I don't know that they can be swayed.
Yeah. Well, it's one of those things, each person has to take into account their own personal situation. And I was out about my atheism and loud about it at the age of 13. And so I have lost friends. Matter of fact, I don't know, like 10 or 15 years after high school ended, I was talking to one of my friends and he said something like, "You're not teaching that shit to your kids, are you?" I was like, excuse me? And it devolved from there because I guess he always knew that I wasn't particularly religious, but I wouldn't tell anybody else. I wouldn't say it out loud. I wouldn't try to convince my own children that it's bullshit. And boom, someone that I've known for 20, 25 years, we don't talk. We've never talked since then. And I'm not really interested because he became just a ginormous flaming asshole. How do you undo that if they're not interested? And I don't think he's interested.
Yeah. Well, I'm sorry that you lost that relationship, but it sounds like it might have just been for the best.
It is. And one of the things I love to ask people, when I'm talking about this, what do you think? Is your life better off by being an atheist, or is it worse off?
Oh, it's definitely better. Even with all the challenges, like the interpersonal things that I kind of have to deal with, it's still way better off to know that you are being honest with yourself, and that you're looking at reality and trying to view it as best you can. Make your internal models match reality as closely as possible. Like that's just a great feeling, and to know that human beings can use their reason, and that there's no shame in that. Like there's no one. We're not sinning against an omnipotent deity by just asking questions and trying to find things out and trying to improve our lives. That we can use our empathy to help others, and that there's no one telling me that I have to hate people or to punish them because of who they want to love or what sex organs they were born with. Like that is so freeing, and it's just so nice to put it away and to know that that I can search for truth, and that there's nothing stopping me, and that there's nothing wrong with it. In fact, that's exactly what I should be doing, and I should be able to ask those questions, no matter what. That there's nothing wrong with the questions. Like that is a valuable thing that I'll carry with me to my grave. I would say, without any hesitation, that my life is better.
That is fantastic. Is there anything you want to cover or tell us before we wrap up? Because that's a pretty good place to wrap up if you don't have anything else.
No, just I love the podcast. I loved meeting you when you were out in my neck of the woods.
Yes. And
hopefully when everything's calmed down, we all have our boosters, we can all get together and do it again.
I look forward to that. And again, JC, thank you so much for spending some time to tell us your story and provide such a beautiful message of hope for the future.
My pleasure, Phil.
Section 6, Jehovah's Administration. He created the world, the hosts of heaven, a man and woman, placed them in a garden. Then the serpent deceived them, and they were cast out and made to earn their bread. Jehovah had been thwarted. Then he tried again. He went on for about 1,600 years trying to civilize the people. No schools, no churches, no Bible, no tracts, nobody taught to read or write, no 10 Commandments. The people grew worse and worse until the merciful Jehovah sent the flood and drowned all the people except Noah and his family, 8 in all. Well, then he started again and changed their diet. At first, Adam and Eve were vegetarians. After the flood, Jehovah said, "Every moving thing that liveth shall be meat for you, snakes and buzzards." Then he failed again, and at the Tower of Babel he dispersed and scattered the people. Finding that he could not succeed with all the people, he thought he would try a few. So he selected Abraham and his descendants. Again he failed, and his chosen people were captured by the Egyptians and enslaved for 400 years. Then he tried again, rescued them from Pharaoh, and started for Palestine. Then he changed their diet, allowing them to eat only the beasts that parted the hoof and chewed the cud. Again he failed. The people hated him and preferred the slavery of Egypt to the freedom of Jehovah. So he kept them wandering until nearly all who came from Egypt had died. Then he tried again, took them into Palestine, and had them governed by judges. This too was a failure. No schools, no Bible. Then he tried kings, and the kings were mostly idolaters. Then the chosen people were conquered and carried into captivity by the Babylonians. Another failure. Then they returned, and Jehovah tried prophets, howlers, and wailers. But the people grew worse and worse. No schools, no sciences, no arts, no commerce. Then Jehovah took upon himself flesh, was born of a woman, and lived among the people that he had been trying to civilize for several thousand years. Then these people, following the law that Jehovah had given them in the wilderness, charged this Jehovah man, this Christ, with blasphemy, tried, convicted, and killed him. Jehovah had failed again. Then he deserted the Jews and turned his attention to the rest of the world. And now the Jews, deserted by Jehovah, persecuted by Christians, are the most prosperous people on the earth. Again has Jehovah failed. What an administration!
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. This Investing Skeptically segment is on a cushion, I guess, on how to use the cushion, how it actually works. I got an email from a friend of the show, and they had the question that, I get that you have these different investments, but when the market's down, how does it actually work? What do you actually do? And when do you know that it's time to put money back into the cushion? How does that all work? And of course, it depends on a lot of things, but I thought I'd make an example. It's overly simplified, profoundly overly simplified, but it's for the purpose of discussing this concept. This may not be the right way to do it for you. It may not be the right numbers, but again, just trying to look at the concept to see how this would work. And in this theoretical example, a person has $1 million and their goal is to take out $50,000 a year, 5%. In this $1 million, they happen to have $350,000 in bonds and $650,000 in stocks. And when I say stocks, I'm going to use the math from the S&P 500, which is not really the total U.S. stock market. And of course, you have other options and way more detailed choices in your investments if you're following the Polaris plan. But again, overly simplified. I get it, just for discussion purposes. And when I say bonds, I'm assuming it's kind of a general mix of conservative bonds because we've been there, even more conservative of a mix than the total bond market index at Vanguard, which you could use. That'd be fine. And so in this case, again, a person has $1 million, $350,000 in bonds, $650,000 in stocks, and I am not suggesting that 35% is the right amount of cushion for you. I actually don't even calculate it that way. I mean, you can. You have two numbers. You can figure out the percent of the total. It's really easy. But I calculate the size of the cushion for people on how many years the cushion will last. Currently, I'm looking for 14 to 15 years. Several years ago, it was 10 to 12. But every year or two when we have a great market, I make it a little bit bigger because why not pocket some of the gains? That's a whole nother topic. Anyway, so we're going to go to the beginning of 2008. And yes, the market was down a little bit in late 07. Again, oversimplified, just for discussion purposes. And let's say you have 350,000 in bonds, 650,000 in stocks, and during the calendar year in 2008, the S&P 500 is down about 37%. That's a really big deal, and you lost, I don't know, on paper, in reality, whatever way you want to look at it, you lost a lot of money. The stock portion of your portfolio took a big hit. It went from 650,000 to around 409, 410. You're down $240,000. Of course, that's 24% of your total portfolio, not 37, because you had a bunch of money in the cushion. So that's kind of cool to start with. But now we get to the end of the year and you want to take out money. And again, this person is taking out 50 grand a year. Of course, it's much easier if you can adjust down the amount that you take out. If you could take 50, but you can live on 40, maybe because you have Social Security or some other things, that would be helpful. But we're going to assume this person cannot do that. They need the full $50,000. One thing that people often forget is with investments, they pay dividends. So again, for the purposes of this example, I'm oversimplifying again, and I'm assuming that you get about 2% in dividends, which on $1 million is about $20,000. So you get to the end of calendar year 2008, and through the year, you've gotten about $20,000 in dividends, and now you still need $30,000. So you sell it from the bonds that are not down, or if they are, they aren't down much. They're not down 37%, and you leave the stock part alone. This is the purpose of the cushion. A generous chunk of your money, making 1 or 2 or 3 or 4%, can look pathetic and stupid when you have a year like last year when the U.S. stock market went up 28.71% as measured by the S&P 500. But when it goes down 37%, it looks genius. And so one of the ideas is to avoid the guessing about when you should do what. One of my strategies is to have a portfolio that works in the good times and the bad. That's the point. You want to take the anxiety out. You want to take the unknown out. And if the market goes up, you make a lot of money. If the market goes down, you're covered. So that's kind of the goal. Now, the market does really well in 2009, 2010, 11, and 12. Let's see, here's the numbers. The market, S&P 500 is up 26.46% in 09, up 15.06 in 10, up 2.11, very small increase, but an increase in 11, and 2012, it's up 16%. While you're waiting for the market to recover, you keep getting the dividends from the stocks, from the bonds. By the way, when bonds go down dramatically, dividends, at least in the short term, do not go down dramatically in dollar amount. They ironically often go up as a percentage. Covered that in other segments, but the basic thing is the company doesn't want to spook you, and if they can pay the dividend, they want to keep paying the dividend so their stock doesn't get beat up some more when they signal that they can't even pay the dividends. It's not quite true. And again, this is oversimplified because your bond portfolio is shrinking a little bit. You're getting less from bonds, but I'm trying to keep it in the relative arena of simple enough that I can explain it in a fucking podcast. So what has happened after these 5 years is you've removed about $150,000 from the bonds, and now your stock portion has fully recovered. At the end of 2012, you have gone all the way up to $705,000 in stocks. We started at 650. Now you have 705. Not a whole lot of gains in the stocks measured over those 5 years, but you are now actually up. If you had sold some stuff near the bottom and you put it in the bonds, getting 1 or 2 or 3%, it's going to take you a decade or more, 15 years, to try to get that money back. It's just not going to happen. That's why you can't sell low. So in this case, we have 705,000 in stocks, and we've now taken 150,000, about 30,000 per year out of the bonds. So the bonds have fallen from 350 to about 200,000. Now that we have more stocks than we started with, more value in stocks, we want to not only switch to selling some stocks, but we want to sell some extra stocks and put money back into the bonds. So with your $705,000, you're now $55,000 over where you started. You can take 30 grand out of there plus dividends from stocks and bonds to make your $50,000 annual deduction. And you still have $25,000 left over that you can add back into bonds. So now the bonds are not at 200, they're at 225. They're still down. And the whole idea is hopefully now the stock market continues to do well for a while. And in this scenario, in 2013, the S&P 500 was up 32.39%. So your 650,000 in stocks that you had at the end of 12 because you took off the cream and spent part of it for yourself, you put part of it back into the cushion. With that 32.39% growth, your $650,000 becomes $860,000. You just made a lot of money because you were still in stocks, because you waited for it to come back. Now you have your annual amount that you want to take out. Again, we're assuming 20,000 comes from dividends. You take 30,000 out to total 50,000, and your 860,000 in stocks is now 830,000 in stocks. And of course, you can take 125 right off the top of that and completely refill the cushion. You are back to $350,000. Now, you could decide to overfill the cushion and make it bigger than 350, but you're back to 350. And even with taking the 125 out of stocks and taking the money that you need that year to get to the 50,000 withdrawal, your stock portion of your portfolio is now $705,000. So 5 years, 1, 2, 3, 5, 6, I guess in the sixth year, we'll call it. In the sixth year, not only are you back to break even, in total, you're up $55,000. You now have not 1 million, but $1,055,000. And you are able to take out $50,000 per year during that 6-year time period. That's what having the cushion can allow you to do. That's why it's not particularly important if you're 20 or 25 or 30 years from retirement. If it goes down, it's a bummer, but then it goes up. Here we're trying to, I guess, rebalance, kind of like a teeter-totter. When stocks go down, you want to sell some of the bonds. When stocks go up, you want to sell some of the stocks and refill the cushion. And of course, in this scenario, going forward, you still have the 350,000 in bonds, but you might now decide that you want to not take out 50,000 a year, but 52,000. And so you can increase the size of the cushion, or you could leave it the fuck alone and let the stock part grow in future years, which it may or may not from that point in time, and it may or may not from this point in time. But that's kind of the gist of when you have a big market downturn, selling from the cushion and waiting a few years for the stock market to come back, and then taking the gains from the stock market and refilling the cushion, generally speaking, will keep you ahead, will keep your portfolio in the long run growing bigger and bigger, even while you take out 5%. So I hope that helped. That's a lot of numbers, I know. But if you have questions, or if I made this all so confusing you don't understand, of course you can send me an email, phil@polarisfinancialplanning.com, and that is going to wrap up this example of how to use the cushion.
You're listening to The Bill Ferguson Show.
Did you guys watch any of the Olympics? Are they even over? I don't know. I haven't checked. I'm not really a sports puck person. But I know that there's Winter Olympics. I don't really know who's doing well or getting medals or not getting medals. And so I don't know really when it started, and I may have missed the fact that it already ended. I don't know. Not something that piques my interest. But there are a lot of other things going on. And of course, from a financial perspective, the thing that's going on now is it's tax season. Welcome everybody to tax season. Your taxes are due by April 15th. Oh, actually, I think it's April 18th, maybe? Is that the Monday after the Friday? I'd have to double check. And I will double check and have it in the show. But give or take around April 15th or a day or two after that, you have to turn in your taxes or ask for a delay. God, I'm not using the right word. An extension where you can actually file your taxes later. Keeping in mind, of course, if you owe money, you better have it in the IRS's hands before April 15th or 18th or whatever it is, before you extend. So you get the draw at the time for you to complete your filing, but it doesn't get the draw at the time that you owe the taxes that are due. So remember that. The other fun thing, of course, is it is RMD season. At least it is in my head. RMD is required minimum distribution. And this might happen if you have an IRA and you're 72 or above. It might be because you have a beneficiary IRA or was it survivor? No, that's not the right word. But an IRA that you got from a parent or a relative that has passed away. There are certain amounts that you might have to take out. If this person passed away after January 1st of 2020, you don't have RMDs, required minimum distributions, until the end of the 10th year. And at the end of the 10th year, the entire amount is required to be pulled out. You probably don't want to do it that way. Consult with your tax professional. But regular RMD season is upon us. One of the things I recommend that people do, and this is really important, and I appreciate my clients that have done this. This is how I do this. You should be figuring out how much you have to take out at, because of 21 or into 22. I don't know which way to call it. But you should be doing that now in the winter. And the calculation is usually based on the amount of your portfolio that you have an RMD that applies to it based on what it is on 12/31, and in this case, 12/31 of 2021. You know that number. You can talk to your financial provider. You can talk to your advisor. You can talk to the brokerage firm, mutual fund company that you work for, whatever it is. Some of them will help you calculate how much money you should take out or you're required to take out. Some may point you to a website, and you can go to different websites and do a calculator to figure out how much you're supposed to get out. Now, the question that people get is, why now, Phil? I have all the way till the end of the year to do this. Yes, you do. You have all of 2022. Don't sweat it. But here's the thing. If you need to sell something so that you have enough cash to take out the required minimum distribution, I generally want to do that at the very beginning of the year, because at the very beginning of the year, the assets are relatively close in value to what they were of 12/31 from the ending of the previous year. If you have almost everything in your beneficiary IRA invested in the stock market, and let's say you're getting up there in age and you're required to take out 4% of the portfolio. Let's say you have $200,000. That's $8,000. If something really freaky happens between now and the end of the year, let's say the market drops 30, 40%, it does not change the amount that you have to take out. You still have to take that out. So at the bottom of the market, you might be compelled to sell and take out more, at least as a percentage of your portfolio, than you had expected. Now, you could also look at it and say, it doesn't really matter because I don't need the money and I'm going to reinvest it in a portfolio that's in a taxable account that's down just as much as the portfolio in the tax privileged account. Okay, maybe that's the case, but maybe you need to spend it. I don't know. I just want to reserve as much money as you can in your IRA or 401k. So one of the reasons is to not get caught where you're taking money out at a loss. And of course, if you had taken it out in January or February and put it in your taxable account and there's a big loss, well, maybe you can have a write-off. You don't get a write-off when you're taking it out of the IRA. So there's different ways to look at it. The other thing for me is more of a technical, psychological thing, is that don't let this haunt you in the fourth quarter when you're like, oh, I got to do this. I got to do this. I got to go do this, because you did it already. You did it back in February. You do it every year in fucking February. or January if you can get the numbers quick enough, or March or whatever. In the first quarter is what I'm going to say is a really good idea. So you don't have to constantly be worrying about, did I take enough out? If you don't really need the income, you could, of course, schedule another vacation and spend it. You could give it the fuck away. You could give it to somebody that needs it, some charity or organization that's helping people out. You don't have to keep the money. You don't have to spend the money. Of course, if it's money that you're going to need, maybe not this year, but in the future, well, now you put it into another investment, probably in a taxable account. Or if you're working and have a 401k, you can up the amount that you're putting in there so that you're kind of taking money out of an IRA and then putting it back into a 401k. But, that's what the RMD creates, these interesting situations. And I think it's a perfectly fine thing to say that if you get to avoid taxes and stuff for a while, that you should be at least required to take out some of the money when you get into your higher years. So anyway, just some thoughts. I have booked all my stuff for the American Atheist Convention in April in Atlanta. So that's Easter weekend in the middle of April, just a couple of months from now or less. So I hope to see you there. Hopefully it's nice and big. It looks like a lot of the rules, at least in the United States, are going away as far as COVID protection. Oh, one of the weird things we met with some friends to go eat dinner, and the place that we went to, you had to whip out your vaccination card, which is cool. I don't actually mind it as an idea. The problem is one person on our party didn't have their card with them. They were vaccinated. They just did not have their card with them. And because this is America, we don't have a nationally recognized system where it's easy and automatic to just show them something on your phone that they have in most of the rest of the modern world. So we couldn't go in to eat. The second place that we went to, they didn't give a shit. They were the other extreme. Almost everyone in the restaurant, all the staff, nobody had a mask on. We got there, thankfully, kind of early because I'm getting old. Not that old, but we got there early. It was late afternoon, early evening, and there was almost no one else there, so we were okay with that. And we sit down. But by the time we were finishing our meal, every single table around us is full, which is great. I'm delighted for this restaurant. But fucking nobody is wearing a mask. And I just started to get a little more anxiety and a little more anxious. And so as soon as I got done eating, I put my mask back on. But I don't know. Is it over? Is it over, people? I know the number of known infections in the last week or two has dropped dramatically. And I'm very optimistic about that. But I don't know. I still get worried about us as Americans not taking what seems to me to be stupidly simple things, like getting your vaccination, getting your second vaccination, getting your fucking booster shot, wearing a mask. It's not that hard. It's just really not that hard. And we can't do the littlest things. So anyway, I didn't expect that rant either. Thank you so much for listening. If you like the show on Apple Podcasts, you can go leave a 5-star review. On Stitcher, you can go leave a 5-star review. If you know of some other place, let me know. If you have questions or content ideas, a good chunk of the content comes from recommendations or questions from listeners like you. Send me an email, phil@Polaris Financial Planning, and I hope to see you at the American Atheist Convention in Atlanta less than 2 months, or about 2 months from now. And please come by and say hello. Until then, ciao.
advances are not appealing. In fact, I'm starting to get the uh-oh feeling. And my mama said my special parts are just for me. So why in the world are you trying to creep?
Stop! Don't touch me there. This is my no-no square. Stop! Don't touch me there. This is my no-no square.
To try and touch my square takes a lot of nerve. Who do you think you are, you freaky deaky perv? There's a dude with some candy in a shady old van. I think he wants to mess with my purity plan.
Stop! Don't touch me there. This is my no-no square. Stop! Don't touch me there. This is my no-no square.
My square's not a circle or a period or a dot. It's just my one little very own spot. So keep your grubby little dirty little hands off me while I won't respect my privacy. I just wanna be left all alone, so step off me and go back home. I'll tell you again if you're not aware that this is my own no-no square.
Stop! Don't touch me there. This is my no-no square. Stop! Don't touch me there.